The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The stock rally presses pause while the bond market sell-off hits the gas. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And as Romaine said, not a pretty picture behind me. The S&P 500 down about 0.5%. Same level of decline if you take a look at the NASDAQ 100. It's a merger Monday. It's Fed week. And we're starting off certainly on a sour note. I did want to highlight small caps catching the barest of bids. The Russell 2000 higher by about 0.1%. But you take a look at the declines in the big benchmarks, not getting any sort of haven bid into the bond market right now. Taking a look at 10-year Treasury yields higher by 3 basis points. We are at 4.16, almost 4.17 on your 10-year Treasury yield, Romaine. That is the highest level since September.
Another interesting day for the price action. A busy merger Monday, failing to really lift the mood on Wall Street. Equities, which remember last week were doggy paddling toward fresh record highs, now struggling just to tread water. Traders on edge despite another solid earnings season, despite the continued boom in AI investment, and despite conviction the Fed will cut rates this week for a third consecutive meeting.
There's a question of how much is appropriate to cut. What you see at the long end is this risk that inflation stays elevated. The dissents are healthy and a good thing. I think the market's going to deal with it just fine.
All right, and if we unpack that last one just a bit here, because despite those rate cut expectations, Treasury yields have drifted higher, not lower, up for 6 of the 7 sessions since Thanksgiving. In fact, at 4.17% on the 10-year and roughly 3.6% on the 2-year, Treasury yields, they're higher today than where they were in September when the Fed began its easing campaign. Curious on one hand, but on the other, go and look at the recent labor market data, or go look at the sticky inflation numbers, or go take a look at the Treasury liquidity that has been sapped by that deluge of corporate bond sales, and you get your answer. Throw in the idea that most asset managers have a relatively optimistic outlook for the U.S. economy into 2026, and you can start to see the reason why that yield steepener trade has become as flat as a pancake. In fact, most Wall Street strategists see a greater case for risk assets next year than this year. Believe it or not, Katie Greifeld, only time will tell.
Only time will tell. We are approaching 2026 at a rapid pace, but I do want to talk a little bit about what Romaine was saying when it comes to the relationship between the Fed's policy rate and yields. You have the 10-year Treasury yield in blue here, and then you have the upper end of the Fed's target rate in white. You go back to September 2024. This was so interesting. You had the Fed cutting rates, and you had the long end absolutely take off. You fast forward to where we are right now, as Romaine mentioned, when the Fed started lowering rates in September. Initially, you did see yields go down a little bit at the 10-year level there, but then you take a look at the ultimate right hand of your screen. You can see that those long end yields, as Romaine mentioned, have started to take off a little bit. So, of course, we're expecting to see that white line go down another tick this week. It's going to be fascinating to see what happens to that blue line, Romaine.
And, of course, a lot will be dependent on where the economy goes, both here in the U.S. and around the world. Let's get some insights out of Gita Gopinath, former chief economist at the International Monetary Fund, now a professor at Harvard University. And, Gita, I do want to start there with the global outlook, if you will, a global outlook that has been challenged and, to a certain extent, under strain for quite some time, but one that has still held up. Does that hold up into 2026?
I believe so, Romaine. I believe that 2026 will be another year where there will be both strength and risks. Strength from the fact that we still have the AI capital expenditure that's happening. You have governments around the world that are also doing much more fiscal spending. You know, the one big beautiful bill, the stimulative effect of that will play out in 2026. I think the risks come from what exactly is the Fed going to do? What is monetary policy going to be? The chart you just showed was very interesting because it is actually highly unusual for the Fed to be cutting interest rates and the 10-year yield to be higher than when they first started cutting interest rates. That is not a common occurrence.
What does that tell you, though, about what the market's view of the economic conditions are relative to some of the expectations for those rate cuts?
I think what it tells you is that it's quite uncertain what's going to happen next year in terms of both inflation, but also Fed interest rates. Markets aren't pricing in the likelihood of an interest rate increase, which is surprising given where the economy is now and given what we are heading into. So I think that is one risk that needs more attention. Secondly, it's a critical year for the Fed 2026 because there's going to be decisions on who the next Fed chair is. We're going to learn a lot more on how monetary policy gets set. And all of that uncertainty, frankly, I don't see that priced in the markets so far.
Well, let's talk about that a little bit more, that last piece there. When it comes to next year, you do have a change in leadership coming up at the Fed. You do have a lot of concerns about Fed independence. There was a really interesting Bloomberg News article over the weekend talking about that divergence that you're seeing between bond yields and the Fed's expected path. And you have some folks voicing concerns that this could reflect potentially that people are worried about whether or not we're going to have a truly independent Federal Reserve come May 2026, Gita. And I wonder if you share those concerns.
I do share some of those concerns because what's important is that even though the chair of the Fed is one person of 12 people making the decision, ultimately the chair goes out and communicates what the path of interest rates are going to be, how do they see the outlook, what is the Fed's reaction function. And all of that needs to be conveyed with confidence. And if we're going to be in an environment where there is a lot of disagreement and dissent, that is much harder to convey. So I do worry about this, and it's one of the risks I'm paying very close attention to.
Yeah, and it'll certainly be interesting to see the scale of the dissents at this Wednesday Fed decision. But Gita, you mentioned, when it comes to some of these concerns, you're not yet seeing that priced in the market. What would you be on the lookout for?
I think I would see some more in terms of, volatility indices. For example, the VIX, it's really sanguine at this moment. If you look at spreads, yes, they've increased some, but not that much. And we have to keep in mind where inflation is. If you look at inflation at 2.8% right now, if you took out the tariff effect, that would have been closer to 2.1%. So the tariffs in and of itself are adding about 0.7 percentage points to inflation. And I don't think that impulse is over yet. I would expect to see another 0.5 percentage point of that impulse coming through next year, on top of all the stimulative effect coming from the one big beautiful bill and the capital expenditure on AI that's going to happen. So there are lots of forces that move in the direction of keeping inflation high and maybe going higher than what we are seeing right now.
I am curious, Gita, about the pushback to that, meaning the fight against it. And at least as to what we know right now, the relative lack of coordination amongst various governments and central banks, the idea that so many countries, including the U.S., for a variety of reasons, have more or less gone alone, basically embarked down this path based on their own individual interests within their own borders. And I'm wondering if that's okay, if that ends up being a mistake. Does it matter?
Firstly, I think governments around the world are in a fiscal expansionary mode. If you look at Japan, they are planning to spend more. In the US, the fiscal deficits are extraordinarily high. Everywhere else, it's not coming down. So we are in this environment where you have high debt and you have central banks who have to decide what interest rates are going to be. And obviously, there's a lot of pressure to bring interest rates down to be able to support low borrowing costs for governments. That is a tension that they're going to face. And in addition, of course, as you mentioned, governments seem to be going it alone. Frankly, 2026 year is a very, very important year to see whether the world actually finds a way of working better together. It's been chaotic, to put it simply, right now in 2025 about trade policy, controls, export controls, sanctions, and so on. If in 2026 we don't figure out a way for countries to work better together, we really are moving towards what I would call slow and silent decoupling everywhere in the world.
All right, Gita, we have to leave it there. Always great insights. Gita Gopinath, former chief economist over at the IMF, now a professor at Harvard University, kicking us off to the close here on this Monday afternoon. We focus on the public markets and we focus on the private, a shifting market there. A conversation with Andrea Auerbach, global head of private investments over at Cambridge Associates. She's going to tell us what new opportunity she's seeing out there.
And from recalibrating capital to recalibrating your sleep, we'll discuss mattress demand and sleep health tech with Linda Findley, Sleep Number's CEO, how the company is getting out of its comfort zone with its new turnaround plan.
All right, well, speaking of comfort zone, let's talk athleisure. Mark Wahlberg, remember him, the actor and co-founder of the athletic wear company Municipal. He's going to be stopping by the program as well, talking about how he has found a way to change the future of performance wear. You don't want to miss that conversation. Stick with us. This is The Close on Bloomberg. Some breaking news on a company called Medline. This is a medical supply company backed by Blackstone and Carlyle, now said to be seeking an IPO of $5.37 billion. Believe it or not, this would actually make it the biggest U.S. IPO this year. Again, that redhead just crossing the Bloomberg terminal right now. Of course, Katie Greifeld, in a year, or at least I should say a second half that's been full of IPOs and other big deals.
Absolutely. Going to keep a close eye on this story. As Romain said, that would be the biggest U.S. IPO this year. But let's get back to the Federal Reserve, which, as we know, is kicking off its two-day policy meeting tomorrow, with the majority of Wall Street expecting a 25 basis point cut. But our next guest says that rate cut probability seems a little high to him, and he believes that if the Fed does not cut rates, there will be, quote, a bit of a sell-off. Let's bring him in now. His name is Matt Rowe. He is the Managing Director of Solutions over at Man Group. Matt, great to have you with us ahead of this meeting, which it seems like Wall Street, again, the consensus there is that this is a lock, but it seems like that looks a little premature to you.
I think so. I mean, I think that's a bit of what we're seeing today is people backing off that certainty that is priced into the market for a 25 basis point cut. Just a couple of weeks ago, Powell mentioned to everybody that it's not a foregone conclusion that we're going to see this type of a cut. And my friend Torsten Slok has mentioned that if it's a data-driven approach, likely we wouldn't get a cut. So a lot of it has to do with the confluence of political motivation, expectations in the market, where risk is priced broadly. But I think it's a tug and a pull between labor markets and inflation, of course, but the data doesn't look terrible.
Well, let's talk about the market's potential reaction function here a little bit more, because, again, you look at the pricing here, the majority of the street thinks that we're going to see a rate cut. In the event that we don't, you called it a bit of a sell-off. Yeah. What does that actually mean? Well,
without getting overly precise on this, I would guess that if we don't get a 25 basis point cut tomorrow, that we see 100 to 300 basis points of take out of the S&P, because we're here almost all-time highs. No surprise that we're seeing a big company like Medline looking to IPO when equity valuations are where they are. And I think it's just a little bit of backing off what has sort of manifested itself to be a pretty strong year.
It gets to this idea, though, too, that given how strong this year has been pretty much across most asset classes, I am curious as to whether we've sort of pulled forward what would normally have been smoothed out, or say over the next year or so, or whether there is a lot more left in the tank.
Yeah, I mean, it's really, of course, very hard to say. One theme that I keep hearing about is the potential credit crisis in the market. And there's a lot of focus on private credit versus traditional lenders. You can't have a credit crisis without a repricing of equity. So as we continue to see bullishness and valuations getting pushed for potential growth and benefit particularly in U.S. markets, I think you have to take a capital structure approach and really look at where you're being best compensated for taking risk. It's one of the reasons why I think now is a good time to be rotating out of growth and momentum and moving into things that are more value oriented, moving out of U.S. into European risk assets broadly.
On that point, though, about credit markets, do you anticipate that we're going to see a crisis sometime soon, or anything even close to it?
I don't think I don't think it's going to be a crisis. I think we're going to see a return to more visible defaults. And every time we have one, people will scrutinize it. They'll take a look at what went wrong in the underwriting process. Not entirely different from what used to happen when the borrower and the lender were a regional bank.
I don't want to belabor this point because, I mean, we had earlier last week, Mark Rowan over at Apollo wrote a very good column on Bloomberg defending private credit, basically saying that the credit quality is a lot higher than what people give it credit for, and then, pun intended. And then we had Dan Ivison on the Odd Lots program over at PIMCO actually saying that, in his view, he thinks credit quality is way overstated because a lot of people basically just shopped around for the best rating that they can get.
I have a lot of respect for both the individuals you just cited. The credit market is enormous, right? If you factor in real estate, both commercial and residential, all the way into CLOs and mortgage-backed securities, it's a massive market. Certain parts have spreads that look to me to be oddly tight, meaning you're not compensated for the short convexity positions that you have. And then there are other parts of private credit that look like the best thing you can put your money into. So I think it depends on where you're focused. And it's an enormous market, and the narrative could fit depending on where you're focused.
Yeah.
Just as an aside, it's interesting to see the equity performance of some of these publicly listed private lenders. You take a look at Apollo shares down 16% year-to-date, Blue Owl down about 28% year-to-date. But let's talk a little bit about government debt, because we were just discussing with Gita Gopinath that you have this unusual divergence in terms of the Fed's policy rate and what we're seeing with 10-year Treasury yields. As she pointed out, that's a very unusual situation. I wonder what you make of that divergence that we're seeing and what it could potentially mean for equity markets if we see it continue to build.
Yeah, so year to date, based on last night's close, roughly, the 30-year is kind of unchanged. We've seen yield curve steepening led by a drop in the front end of the curve. That's really a big part of what's been fueling equity valuations and kind of where the narrative for constructive investment has gone, especially it's lowering base rates for corporate borrowing out to the 5-year, 10-year point. We think, myself and Christina Hooper, who's our strategist at Man, share the opinion that there's a relatively high probability of stagflation and a mild recession going into next year. The argument against that is consumer spending still seems to be pretty strong. So how that plays out in the yield curve, I continue to think we're going to see steepening as people look to diversify away from U.S. assets, not in a panic, but a little bit as just a normal course of business.
Just real quick, we'll only have about 30 seconds, but on that stagflation point, we just had the president speaking at an economic meeting down in Washington. Basically says he thinks inflation will come down, but he's very specifically said we're not going into a deflationary period. And I'm curious does that change the calculus for the Fed? I mean, assuming he's right, and quite frankly, we've heard other economists echo that sense. Does that change the calculus?
Yeah, it does. I think if we actually see prices come down, then that will be a very different picture. What we've been dealing with and what the visibility is on a go-forward basis now is that prices, as the consumer feels them, have been rising. As policies change and that makes its way through the market to pricing, that would definitely have an impact. But right now, we still see companies struggle to pass on these higher costs, and they are landing in the consumer's lap.
All right, I've got to leave it there. Matt, always great to catch up with you. One of the best in the business. Matt Rowe, Managing Director of Solutions over at Man Group, as we continue to march towards those closing bells. When we come back, we're going to talk about the story of the day. Paramount making an 11th hour bid for Warner Brothers, splashing the cash, but not everyone thinks that's going to be enough. Doug Creutz is going to be joining us from TD Cowen. Stick with us. This is The Close on Bloomberg. Let's get right to our top calls. Big movers on the back of analyst recommendations. Lennar up first with Barclays cutting the home builder to underweight, but taking the price target slightly up to 98. Bigger picture questions around affordability, employment, and migration, dampening any benefits that could come from Fed easing. The shares down 2%. Next up, Ulta, TD Cowen boosting the beauty retailer to buy from hold a street high target of $725, saying it can usher in a more dynamic phase of growth going forward. The share is still down 1.5%. And finally, Generac, JP Morgan upgrading the company to overweight from neutral, maintaining the $200 target, saying Generac can take advantage of the market's power needs alongside unlikely competitor Caterpillar. Those shares up 1% on the day, and those are some of our top calls. Let's get right to the big story of the day and the media merger mania heating up. Paramount Skydance making a hostile $108 billion bid for Warner Brothers Discovery in the wake of Netflix's offer to buy it itself. Joining us right now to talk a little bit more about this is Doug Creutz, Senior Media and Entertainment Analyst over at TD Cowen. I thought Netflix's offer was a little rich, Doug. At $108 billion, how exactly are the Ellisons going to extract value from that if they were to win?
I think, look, it's a great question. Warner was trading at $12 a share 3 months ago, and we had a buy in it then. We had a price target around, I think, 16 or so. But 30 is a big number. They've said they think they can get $6 billion in synergies out of the combination of Paramount and Warner. That's another big number. I think when Warner and Discovery merged, they took out $4 billion in synergies. Those are obviously taken out. So they have to get a lot of synergies, cost synergies out of the deal. They have to figure out how to generate value from the linear networks. They have to figure out a way to merge the two streaming services. without having it be 1 + 1 = 1.5. You know, there's a lot of question marks, basically. Yeah. They clearly are very determined to land this asset.
Well, let's talk a little bit about how the cable channels are being valued, because you take a look at Bloomberg News reporting, it seems like Paramount is valuing the spinoff at $2 a share for Warner investors. But then you take a look at Bloomberg Intelligence saying that the cable channels are probably worth $4 per share in the Netflix bid. I wonder, you know, where you fall on how much those cable channels are actually worth.
Yeah, I'd say I'm closer to $2 than $4. You know, when you look at where comps are trading, AMC Networks is out there. They're a pure play cable network asset. I think Versant, there's a sense of where that's going to trade. I think $2 is probably closer to right than $4. A lot of it has to do with how much leverage actually winds up on those assets when they get spun out. But, you know, I don't know whether it's 2 or 4. I don't know that you get a wildly different conclusion as to which bid feels better, given that the Paramount bid is all cash and you're getting $30. The Netflix bid, you're getting some Netflix stock, and you're getting this spun off asset that we can discuss where it should be valued. But it's a discussion. It's not a clear amount of cash.
Well, I am curious too, Doug. I mean, it's one thing to say what investors want, but this feels a little bit different in the sense that a big part of this decision is going to boil down to what Washington wants. And by Washington, I mean the White House. And by the White House, I mean Trump. Do you have any way to model that in to your outlook? Yeah,
look, I think both Netflix and Paramount have expressed that they are confident they can get this through the regulatory process. They would say that. From an outside observer perspective, it does feel like Paramount is closer to the Trump administration than Netflix is. There are some ideological benefits to the Trump admin of Paramount landing the deal, namely that they will then wind up with CNN. And clearly Paramount is charting a somewhat more conservative course for their news coverage at CBS. One would think that would also happen at CNN. Whereas if Netflix buys the streaming and studio, then, you know, the cable networks, including CNN, get spun out and anyone could wind up with them, or no one could wind up with them and they could just stay out there. I wouldn't underrate, though, the importance of other regulators, including state attorney generals, and especially California. Right? They're going to have an entirely different viewpoint and basis for example.
All right, Doug, unfortunately, we are up against the clock. Have to have you back soon. That is Doug Creutz of TD Cowen. This is The Close on Bloomberg.
There are very few leaders in the world that can do that and that can create those kind of companies and that kind of value. So I think people are just right now in the private markets, they have this FOMO over AI that they need to get in, that they need to be part of it. And that's going to cause a lot of young people to make a lot of mistakes.
Orlando Bravo over at Thoma Bravo speaking a little bit earlier. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld. Yeah. Really interesting comments, too, because we talk about FOMO in the context of public markets all the time. It explains a lot, certainly when you think about the past 5 years. Interesting to hear the perspective that you're seeing a little bit of it in the private markets as well.
And I love this conversation we've been having with seemingly for days, weeks, months on end about kind of the health of the private investment space. But a lot of it has to do with the lack of transparency, right? I mean, people are kind of guessing, trying to figure out the health of these companies, whether losses are being shielded or whether, all of the gloom and doom that you're hearing from some people is just, Pollyanna-ish and that things are okay. And it's hard to really know what's going on behind the scenes sometimes other than what, people like Orlando Bravo or Mark Rowan or some of the others tell us.
Exactly. There's this sense that, okay, you can't check the real-time information, the real-time price movement, so you're just sort of waiting for a shoe to drop if there is one. But let's keep this conversation
What if there is
going.
no shoe, Katie Greifeld?
That's the thing. There might not be a shoe at all. We might just be floating. Anyway, Andrea Auerbach, she is Global Head of Private Investments over at Cambridge Associates. She joins us now. Andrea, great to have you with us. Would love to hear you weigh in on this conversation. It's the perspective of Orlando Bravo that you take a look at private markets. There's a lot of FOMO there when it comes to AI. Are you seeing something similar?
Katie, we are. In fact, our outlook for 26, the advice that we're giving our clients and we're acting on is really looking for the value amid the hype. And that hype has a name, and it's the AI hype cycle. And so something that we are familiar with seeing, we've been investing in the private market since the 70s. So we have a lot of experience and scars and wrinkles around this exact question. And the AI hype cycle is not unfamiliar to us. We've seen it in other moments in the private markets as well.
It's interesting. I mean, you think about what FOMO, what hype cycles typically entail, again, in the public markets, and you see investors maybe go into risky or speculative sort of assets, companies that haven't exactly been proven because they don't want to miss out on the potential gains. Are you seeing any of that behavior specifically? Maybe investors getting involved in investments that perhaps they shouldn't?
Katie, I think the answer within the private markets, it's a broad space, right? So within the AI ecosystem itself, you've got infrastructure providing the electricity transmission, the grid lines, you've got the data centers, then you've got the semiconductors, and then the AI native applications, which is really the venture capital layer of the AI parfait. Then you move up into growth equity, buyout, and then credit kind of is investing and lending around this entire parfait that I'm describing. And I think what you're talking about, Katie, is that venture capital layer, which we have been watching a lot of dollars going into AI native applications. We're watching a lot of venture capital funds raising money to go right at this space. And it does feel like there's a bit of that FOMO pull that Orlando was describing earlier.
I wonder if you can talk a little bit, too, Andrea, just about kind of the evolution of this industry. We're now 4 or 5 decades into this great experiment when it comes to private investments, or at least what we think of today as private investments. But there's always been this sense here that we never really sort of got our sea legs back coming out of the pandemic in 2020 and 2021. And it gets to this idea of what really is going on behind the curtain. And I'm wondering if we should be worried about some sort of reckoning that is yet to materialize?
Romaine, it's well observed, very well observed. And so we did notice that there was a bit of a boom-bust cycle coming out of the 21-22 cycle, specifically in expansion stage venture. But what we observed in early stage venture is actually the valuations at that tier of the venture capital ecosystem just kept moving up and to the right, buoyed quite a bit by the AI hype that is happening and the investment that's there. Now, what I would tell you is, what we've observed, and you know this as well, which is venture capital is a very long-lived investment strategy. The funds that are investing in AI companies or venture-backed companies can go for 15 or 17 years. So any one movement in 1 year could be considered a bit extreme. And so the advice that we're living and walking with our clients is 2026, we're going to continue to see this AI hype play through, maintain your line of sight on where you're investing, and keep a very high bar for the venture managers that you want to invest behind.
Well, this also gets to the idea that, Andrea, of some of the concerns that investors have had, particularly limited partners. And of course, now with this new crop of individual investors in theory coming into this market, a lot of concerns about liquidity. We've seen the secondary market boom this year. That's good, obviously, for business. But some people also feel that that boom in the secondary market is to a certain extent masking some of the pain that's going on behind the scenes.
I appreciate that, Romaine. And we definitely have watched secondaries start to build more momentum around that particular strategy as limited partners and general partners, the managers, are seeking ways to manufacture liquidity to get distributions back to their investors. Now, what I would also observe, though, is that secondaries are currently only just 5% of total private market activity. So there's a lot of room for that strategy to move and run. And it's also becoming popular with the evergreen and interval funds that we've been watching also pop up along the landscape to feed the individual investor with exposure.
And I do want to talk a little bit more about that individual investor, because one of the narratives around private markets, private assets, investments in general in 2025 was that one of the reasons why you saw managers try to seek out that retail bid was because, you know, you think about the traditional fundraising sources, institutions, that was tending to slow a little bit. How do you see that sort of evolving in 2026, and whether or not we're going to see the baton continue to be passed here?
Katie, what we believe we'll be seeing in 2026 is a reinvigoration of the private markets. We believe that the markets have troughed, and so institutional fundraising is likely to continue to climb and resume its upward trajectory, and it will be augmented by more of the individual investor capital that's coming into the space. But the other thing I'd observe here is that a lot of that individual investor capital is being pursued and capably pursued by a smaller subset of managers. There are tens of thousands of private investment managers in the landscape, and we believe there's a certain cohort, a very small subset, are really positioning to take in all that capital, which will create new challenges for that part of the ecosystem in the private markets.
I am curious with the size of companies. I'm talking about new investments in companies. The size of those investments. Are you still seeing, if at all, appetite for, I guess, some of the smaller companies? Because I continue to hear both from VCs as well as on the private equity side, this idea of sort of wanting to deal with more mature companies, or at least companies that have much more established cash flow and growth than maybe what we would have seen, I don't know, 10 years ago.
Romaine, what we see is companies of varying sizes, and can be as little as 5 million in revenue or 3 million in revenue, all the way up to hundreds of millions, billion of revenue. So the private markets are really cover a very wide range of company ages and stages. And within the private markets, you have different managers that specialize in earning competitive returns at different segments of that market. So what you're describing, and as I'm hearing that, there are definitely certain investors that may want to diversify away from maybe growth at aggressive costs, right? And maybe seek out adding more businesses that may have more stable cash flows during what could be perceived as a more uncertain time as we roll into 2026. Now, there's other strategies that we've been talking to our clients about moving into 2026 to offset the AI, so let's say, hype cycle and the active investing that's going on in there. And we're looking at more strategies that might be diversifying and have more resilient cash flows. Think royalties, pharma, media, content, and also insurance-linked securities are also areas that we like to add more ballast to to our clients' portfolios.
Andrea, always a great conversation. Great to have you. Andrea Auerbach, Global Head of Private Investments over at Cambridge Associates, as we continue to count you down to the closing bells with a couple of big deals announced today. Of course, a lot of talk about the Paramount and the potential tie-up with Warner Brothers Discovery. Getting lost in the shuffle, though, is a big deal by IBM, buying Confluent for $9.3 billion. It's our stock of the hour, and it's coming up next. This is The Close on Bloomberg. Our stock is of the hour today. We're taking a closer look at IBM and Confluent. IBM going to buy the data platform for about $9 billion, one of the largest deals to date, and just the latest peg in an AI flywheel. They can't seem to quit. Bloomberg's market correspondent, Norah Mulinda, joining us right now. I'll talk a little bit, I'm not sure where that last line meant, but we talk about just sort of IBM's big push and what Ivor and Kristen has been trying to do to really assert themselves in AI. And of course, IBM would tell you they were doing AI long before it was cool. But buying Confluent, I mean, that is a huge flex here, but it's also very expensive.
Very expensive,
yeah.
But it is a big flex. I mean, of course, we do know that IBM hasn't necessarily been a leader, if we think about it, in terms of against Amazon, Google, in terms of this AI push, but they've really carved out their own niche. They're really focused on enterprise. They're focused on businesses and bringing functionalities and artificial intelligence in that sense. And so that's why you definitely see Confluent being a particularly good target here. If you think about Confluent, they're essentially a company that focuses on high-speed data pipelines. So think of it almost like a highway. They're just trying to get things to move faster here. So maybe banks are able to detect fraud at a faster pace than they would have been able to before. Or if you think about a retailer actually really digesting the data when shoppers are making these purchases so they can actually readjust prices here. That's what Confluent does, and that's exactly essentially filling a gap of what IBM really needs in this moment.
Yeah, and IBM clearly willing to pay up for that. $9.3 billion. That's one of the biggest purchases for IBM in recent history.
Absolutely. And also Confluent, they really needed this deal. I mean, this is the company that IPO'd just back in 2021. So we did see a bit of weakness after they did IPO. They've kind of been struggling. There's a lot of macro headwinds, of course, going on, but it's also major competition right now if you think about the artificial intelligence industry more broadly. But they did bring on an investment bank, and they started to get a lot of traction, a lot of attention from a lot of other companies that wanted to potentially take them over and bring them into their portfolio. So you're seeing IBM as the winner here, but it's just definitely a deal that Confluent also needed.
Are we seeing any other stocks sort of move on this? I mean, anytime you have these types of deals, everyone, of course, starts looking for who the competitors are to Confluent. Could they potentially be bought or something like that? Or is this just kind of confined to these two companies?
We've really been looking at this company specifically, but I do think what's interesting is that you also were seeing shares of IBM up in the green. And I think about a lot of companies when they're purchasing another name, it's the company they're purchasing that you start to see rally or react off of the news. But we are also seeing shares of IBM rising as well. So analysts are also thinking that this may just be broader positivity about continued deals here in the AI space outside of just the traditional data center push that we've been seeing so broadly.
International business machines with a big purchase. Norah, Mulinda, great reporting as always.
You went for like the full government name.
I love,
you know, I think they changed their name a while ago. You know,
but
they're just IBM now. Just rolls off the tongue.
It still stands for something though. International business machines. Yeah. What those business machines are, you know, I think that definition has changed since IBM has been alive.
They're machines that help to run businesses.
That's true. Anyway, coming up, we're going to take you to the closing bell with
I have
Alli
to educate her every day.
McCartney. She is Managing Director of Wealth Management and Private Wealth Advisor over at UBS Alignment Partners. That conversation up next. This is The Close.
10 minutes away from the closing bells. Romain Bostic here with Katie Greifeld. Stocks pretty much across the board, at least the major indices, with the exception of the Russell in the red on the day.
Yeah, the S&P 500 down by 0.5%. The NASDAQ 100 off by about 0.4%. We did eke out slight gains last week. We've more than reversed them so far on this Monday. It's interesting to see the Russell 2000 actually be the slight outperformer here, up about 0.1%, even though you have this sell-off in the bond market continuing here, Romain. The 10-year yield higher by about 3 basis points as we count down to that Fed meeting.
I'm curious about the Russell, too, because we've talked with a lot of analysts and strategists, and even Ed Yardeni was out with a note this morning talking about this idea of being a little bit short, or at least not overweight, the mega cap tech, and actually overweighting more in some of those smaller cyclical sectors. He wants to overweight financials, healthcare, and I think industrials were in there as well. But a lot of investors seem to have gotten that bug for a variety of reasons, and maybe that's part of the reason why you're seeing the outperformance once again by the Russell.
Yeah, it seems like the folks that we listen to, that we talk to, there is that itchiness to go long small caps.
Yeah.
But in terms of a consistent bid, it seems like it's hard to find when you have all these questions still over what the Fed is actually going to deliver in terms of its trajectory on rate cuts.
All right, well, let's get some insights out of our next guest as we move closer to these closing bells. Alli McCartney is Managing Director of Wealth Management and a Private Wealth Advisor at UBS Alignment Partners. And Alli, I do want to start there with sort of portfolio allocation into 2026 with the eye on the idea that a lot of people, assuming they were fully invested this year, are sitting on some pretty healthy gains, primarily because of the big bump up that we saw in mega cap tech stocks. Is it now time to take some of those profits and think about maybe allocating elsewhere?
So that's not only an issue from this year, right? If you think about it, that's a 3-year sort of 80 to 140% issue. But the question is, the way that I think for clients about every dollar is from an after-tax perspective, what is the best use of capital going forward? And you have to believe in order to do that the best use of capital is not continuing to invest in those hyperscalers with the AI trade. And having just spent all of last week at UBS's AI conference in Phoenix, it was attended by a few thousand global companies and investors. I'm fascinated by what's going on in the healthcare space, in the AI space, in the, any space you can really think of. And so that's not really where I'm taking gains for clients. I have been a heavy investor in precious metals. I didn't expect to have the run up that we had this year, fueled by, flight to quality, especially during the March and April trade tensions, waning US dollar, bids from overseas sovereigns. So that's a place. But again, you have to figure, what are you expecting going forward? And with numbers that are going to come out from an earnings perspective, probably of about somewhere between 12 and 14% this year. And we're expecting a not dissimilar number next year. I think we probably have another good equities year.
Okay, all right, another good equities year. Is that also partly due to the potential for Fed support, or at least the perception that this market has right now, that we will see easier monetary policy into next year?
Absolutely, right? And I think you were just talking about the small caps, and that's why people are there's a lot of momentum or desire to go there, because especially not knowing what the composition of the Fed will look like. And we will have more, obviously, more clarity into that soon. But there's certainly going to be a rate cut on Wednesday. There is likely going to be a rate cut in January or the first quarter. And if we have a new Fed chair that is very aligned politically with the administration and has the same goals of, being able to continue to finance our debt, et cetera, then we get into a world where you have the Fed tailwinds in terms of decreasing interest rates. You have the tailwinds of AI, both helping to cut costs and increase revenues. So like a dual bump to profitability for not only tech companies, but also much more broadly, any company that can be more efficient. And then thirdly, you have earnings growth, that is really above average. So with those three things, absolutely, there should be a number of tailwinds. The one thing that I would caution is that the risks are real and in a sense getting better or getting bigger, but getting less priced into markets in terms of, for example, sort of, your Sharpe ratios. And the other thing is that the growth that's expected both in earnings and in GDP is likely to be front loaded next year because of a lot of the implications, both for individuals and for companies in the big, beautiful bill.
I do want to talk a little bit about Fed risks, though, because, you mentioned that we're going to have that leadership transition next year. There is the concern being worked through the bond market that, should you have a new Fed chair who is on board with the Trump administration's leanings in terms of lower interest rates, that perhaps this new Fed chair will be more dovish than what the economy actually needs. That's been pointed to as a reason for why you're seeing these elevated levels when it comes to the 10-year yield, when it comes to the 30-year yield. Alli, I wonder, how much water you put in that sort of theory.
Katie, that's a real risk, right? And you can see that the administration and to a certain extent through the Treasury largely right now, they're concerned about that too, right? So they're trying to have more bought on the long end. They're trying to issue more on the short end because that's really been the issue in this market. And it's been the issue for a while, both economically and politically, which is the Fed can really only affect the short end. It can't affect housing affordability or sort of the 10 to 30 year. And so when you say there's a risk of that, I think there is absolutely a risk of that we sort of use monetary policy to keep all of this going to the extent that we create significant issues on the longer end, both in terms of the Treasury curve, but also in terms of timeliness. And, and because ultimately, the real thing that's happening here when we look at the consumer, who is clearly on the lower end facing inflation, will continue to face inflation as we see a lot of, let's say, the August tariffs play through into Q1, is that housing affordability and ability to tap equity in houses, which has been a huge source of GDP and growth for this country, is really at risk if we have 6% mortgage rates for the near future.
All right, Alli, always great to catch up with you. Alli McCartney there, Managing Director of Wealth Management over at UBS Alignment Partners, counting us down to the closing bells as you keep an eye on the markets right now. Not far off the lows of the session, but the declines today, Katie Greifeld, fractional to be sure.
Absolutely. It feels a little bit like wait and see mode. Of course, we're out of the heart of earnings season. We know that consequential Fed decision is coming up in 2 days' time. And it's not just, of course, what they do on Wednesday, but what the commentary about 2026 looks like.
We do get some earnings this week. Costco. Are you a Costco person? Lululemon. You're an athleisure person, aren't you?
I am, actually.
We're going to catch up with Mark Wahlberg a little bit later, who has a way to change the future of athleisure. In the meantime, our global simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld taking you through to that closing bell with a global simulcast. We're joined right now by Carol Masser in the radio booth alongside Tim Stenovec, who's lost a little bit of hair. Actually, it looks like Matt Miller filling in today for Tim Stenovec. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. A down day, Carol Masser here on This Money, though we should point out, probably best described as a bit more of a holding pattern as a lot of people wait for the Fed's meeting on Wednesday.
Yeah, what indications do we get in terms of rates going into 2026? I mean, basically the rate cut on Wednesday, it is definitely baked in already, but it's really the outlook, the summary of economic projections and more. But I also think, is there a point where people are like starting to dismiss what Jay Powell has to say because he will not be there
Does
for
it
the
become
entire year of next year.
a lame duck?
Yeah, I don't know.
It will be interesting also to see if he actually is there, because remember, he could stay at the Fed.
Wouldn't that be wild
after,
if that's what
being
happens?
chair.
Yeah,
Although
could
I
happen.
would probably just want to chill after that, after this kind of
Go
stressful.
fishing in Montana?
It's been
Yeah, I would ski.
Okay.
It's been a trying couple of months, certainly.
Hi, Katie.
Hi, Matt. How are you?
I'm doing well. Miss you.
I miss you too. It's so nice to be joined together on our global simulcast. I'm most interested to see what yields do on Wednesday. We've been talking about it all show, Romaine and I, how you're seeing that divergence between the Fed's policy rate, what the long end is doing, and whether or not we're going to see that gap continue to grow.
We get the closing bells here in New York. I was just saying a little while ago here that stocks were off the session lows. We should point out a couple of huge block trades just coming in across the tape right now as we get closer to the bells, and that's causing a bit of a bump higher, still in the red for the S&P, but a bump well off those lows here as we close out the session on this Monday. The Dow Jones Industrial Average down more than 200 points, or 0.4%. A similar percentage drop for the S&P 500. The Nasdaq Composite down about 0.1% here on the day. The Nasdaq 100 down about 0.25%, and the Russell 2000, that's your outperformer. It had been oscillating between gains and losses on the day. It looks like it's going to finish just basically at the waterline in the red, but only down by, it looks like, just less than 1 point.
All right. Yeah, small move there. Hey, back to the S&P 500 I go. Most names, though, in that index lower today. About 345 names losing ground on this Monday, 157 to the upside. And Katie, you've got one unchanged.
Let's take a look at the circle and take a look at the sector level, because it's broadly the same story, if not a little bit more dramatic. You do have one important slice that's green, and that is tech. NVIDIA, your biggest points contributor to that sector, up about 0.9%. But you take a look at the rest of the sector landscape. 10 sectors finishing in the red in terms of which was your worst performer today. Communication services down by 1.8%. Materials and consumer discretionary also finishing in the red as well, Carol.
All right, a lot of red there. So let's get to some of the individual gainers. No surprise, a big story today in the media sector had to do with the race to buy Warner Brothers Discovery, if you will. Warner Brothers Discovery finishing off its highs. At its highs intraday was up 8%, but it is the #1 gainer in the NASDAQ 100, #2 gainer in the S&P 500, finishing the day up about 4.5% here. You know the story. Paramount Skydance launching a hostile takeover bid for Warner Brothers Discovery, $30 a share in cash, and that's just days after the company agreed to a deal with Netflix. The offer valuing Warner Brothers at $108.4 billion, including debt. I mean, the race is on, the bidding is on. We'll see where this one lands. Paramount Skydance, that was your #1 gainer in the S&P 500. That stock up 9% in today's session.
The differential between what Netflix is offering and what Paramount is offering is phenomenal to me. And I'm trying to think of the last time we saw a major merger and acquisition deal where you had two bidders that far apart in terms of what they were offering.
It's interesting. I'm sure you talked to Gita Ranganathan today. I talked to her as well. She points out that the Netflix bid at $27.75 also includes the spin-off of the cable assets, which they valued about $4.
Right.
So that's actually a $32 bid.
Yeah.
A little bit more than what you're getting from Paramount at 30 even. But if this deal is quashed and then Netflix has to fork over the $5.8 billion breakup fee, then gets the Paramount deal, it's far more money.
Yep, a lot
for
of
Warner Brothers, for
a lot of moving
Zaslav.
parts. And it ain't done yet, so we'll continue to keep an eye on that one. Hey, Katie mentioned NVIDIA, certainly some help in terms of supporting the equity trade. That one finishing off its highs of the day, but still with a 1.7% gain. We did see Semaphore coming out, citing a person with knowledge of this, that NVIDIA will soon be allowed to export its H200 chips to China. U.S. Commerce Secretary Howard Lutnick said to support the plan again, according to Semaphore. So some outperformance in that name. And just one more chip name I want to mention, Broadcom. AVGO is the ticker. It's the #4 gainer in the NASDAQ 100. Saw some reporting on this that Broadcom was up on a disputed report that Microsoft is in talks to move its custom chip business. Information reported late Friday that Microsoft is in discussions with Broadcom to design future custom chips, which would be a move away from its alliance with Marvell Marvell?
Marvell. But a disputed report.
A disputed report. So anyway, but Broadcom shares up about 2.8% today.
We should point out Broadcom expected to report earnings this Thursday.
Yeah, it's up about 73% year to date as well. Yeah.
All right, here are some of the losers. Netflix obviously is down again today. This is a puzzler to me, and I don't know if you guys have figured it out, but when Netflix put in its official bid last week, it was down. And in fact, it's been down every day for 4 trading sessions in a row. When Paramount comes out with a hostile offer, it's up.
Yeah.
So it's like Paramount investors want them to spend over $100 billion, please. And Netflix bidders are like, or investors are like, that's maybe too much.
We were actually just talking about this. We didn't land on a conclusion, but Romain did point out that you take a look at Paramount shares last week, just what they were doing on Friday, Thursday. They haven't exactly climbed out of this hole, but I do also think it's curious, Matt, that you are seeing shares rise 7% on a hostile bid, but go figure.
So Air Products is another one off today. Air Products down after it said it's working with Yara International out of Norway to establish a long-term partnership on a pair of ammonia projects in the U.S. and Saudi Arabia. Potentially a sale in the works there, and that's what has investors selling the shares. Procter & Gamble shares, not a huge drop in P&G, but a couple of different analysts at Barclays and at Deutsche Bank said that they've met with executives at P&G recently, and they were encouraged to bring their estimates down, so that's not great news. And then Marvell Technology, those shares getting decimated today after a benchmark company cut its recommendation to a hold from a buy on expected lost business from Amazon. Also, they're being pressured after the company was not included in the newest additions to the S&P 500 index, and we love those rotation trades.
Absolutely here, and also looking, it was interesting too to see quite a few of the retailers down here on the day as well as some of the holiday spending data continues to come through. I do want to draw our viewers' attention real quickly to PepsiCo. We had a headline across the Bloomberg terminal that PepsiCo was telling its North American employees to work remotely this week, and that it's anticipating changes that, in its words, could, quote, affect some roles. The Wall Street Journal now out with a report seemingly tying this to that activist campaign by Elliott Investment Management, an activist campaign that Bloomberg has been reporting on quite frequently. And it does appear that some of these cost cuts are going to be tied to that, about 20% cost cutting across the board. Not quite sure exactly how that stacks up in terms of the number of employees or the potential cost savings, but we're going to try to dig a little bit deeper, guys, and get you some more information on that. Yeah, right now we're seeing, as you mentioned, PepsiCo unchanged here in the aftermarket. All right, we'll keep an eye on that. Hey, one of the things that Matt and I think we're keeping an eye on, although he might. Why are you two staring at each other? He might go rogue on me. Did you guys talk about this? He might go rogue. No, we didn't. We didn't. So we're going to get to what is one of the most read stories on the Bloomberg. I think it's in the top 20. But it was in the
top 20.
It was a red
K-pop Demon Hunters?
It was a red sticky when it crossed.
Mark Wahlberg?
All right. No, we're not doing.
I can't wait. Is that just 20 minutes time until Mark Wahlberg comes on?
Stop.
450 actually. So
Jimmy Kimmel extending his deal with Walt Disney's ABC for at least a year. So they're bringing
Jimmy Kimmel. I thought he was canceled.
No.
Surprise.
Oh.
No, remember that whole, snafu, and he was off the air, and then he was brought back, and certainly the White House watching.
What was the snafu? Explain it to me.
No, I'm not going to do it.
Oh,
just go to the Bloomberg and read it. Okay, sure. But anyway, Walt Disney's going to bring him back for at least one more year under a new one-year deal with the ABC network.
It's interesting to look at the details here. Apparently, Kimmel and Disney agreed on this extension months ago, but they delayed announcing their plans out of respect for fellow late-night host Stephen Colbert, who personally I love, one of my favorite comedians. But we know that CBS announced in July that the Late Show with Stephen Colbert will end in May of 2026, which is also when Fed Chair Jerome Powell will, step away from being Fed Chair.
Maybe they'll do something together.
I would love that.
Powell and Colbert. I don't get the whole late night thing. Is that still a thing? They don't make money. Do people really watch it? Do they bring guests in? Is it important for a network? Kimmel was hilarious when he was taking kids' Halloween candy away. But since then?
Yeah, I don't know if it works as, a live program, but certainly, you think about SNL as well. A lot of people find those clips on YouTube after the fact or on TikTok.
What should they run at night, Matt?
What should they?
Late night?
Should they just go back to like bars on the screen or play the national anthem like when we were
exactly.
kids?
When I was a kid,
PM,
TV just ended at a certain time, and then there was static or bars.
No one knows the struggle, Matt.
All right.
Yeah, there was nothing to do at night.
But no, now we stream stuff, right? Now I'm watching YouTube all night, so there's no need for live broadcast.
Yeah.
I think their commentary has
What
some
YouTube
value.
videos are you watching? Let me guess. I assume it's a lot of car.
That's right.
All right, we got to go.
I'm watching car videos.
Finley says we got to go. We got to go. So
which is the most important generation of the 997 911? Is it 991.2 or 991.1?
Watch this 45-minute video.
Katie and I were just having that debate right before the show.
All right,
today.
does everybody understand what wrap means, Finley? I'm trying. All right, that is a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We call it the closing bell. Romaine and Katie continuing there on the close. Matt and I continuing right here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
All right, the year is almost over. We're going to discuss some of the big moves in S&P targets and where the markets go next. Adrian Helfert, CIO of Multi-Asset Strategies at Westwood. He's joining the big program in a second. Stick with us. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostick. An interesting start to the week, a Fed week, we should point out. A big decision scheduled for Wednesday. And that actually had the market in a little bit of a holding pattern. Not so much just trying to decide what the Fed does on Wednesday, but more importantly, about what it does next. The S&P pulled back just a tad here on the day, down about 3 to 0.4%. You saw a similar move lower for most of the other indices, so we did see continued outperformance by the small and mid caps. Russell 2000 basically flatlined on the day, coming off that record high that it set on Thursday. But keep an eye on the bond sell-off, a global bond sell-off, and it continues here despite the expectations that the Fed rates are going to go down. We should point out Treasury rates, Katie Greifeld, have been going up, basically going up for 6 of the past 7 sessions now, above, believe it or not, where we were when the Fed started cutting rates back in September.
Getting some deja vu to September 2024, but there's a lot of red on that screen, so I put a lot of green on mine in terms of the individual movers on this Monday. Paramount Skydance, as we've been talking about all show, soaring about 9%, making that hostile bid for Warner Brothers. You can see certainly shareholders deciding to reward that. Carvana also getting the nod late on Friday that it will be included in the S&P 500. That is good for a 12% rise. And NVIDIA, no specific news, but it did rise by 1.7% on a points basis. That was your biggest contributor to the S&P 500 today. But let's get to our top story this hour, and that is Wall Street's biggest bulls getting even more bullish. John Stoltzfus and the team over at Oppenheimer expecting the S&P 500 to rise 18% in 2026. That is a street high of 8,100. Now, Stoltzfus citing persistent resilience in U.S. economic data and corporate results, expecting that to deliver big gains once again to the big benchmark, Romaine.
Absolutely. Let's bring Adrian Helfert into the conversation, CIO of Multi-Asset Strategies at Westwood Management. And Adrian, you've apparently turned a little bit more, I guess, I don't know if bullish is the word, but certainly a little bit more positive on equities heading into 2026?
More positive, and you might say more bullish. And certainly that 18% you just mentioned is not out of context with the last 13, 14 years that we have seen an average and a median on the S&P 500 return around 16.5%. So a significant rise in the past. We're looking at big change from technological innovation, certainly AI, the spending train still continuing. So we are looking at a significant rise in the equity market next year. And we've got a release in things like tax refunds that we'll see from both the corporate and the consumer side. So there are some drivers there that will give a lift to markets next year, we believe.
How much, if at all, does the Fed matter?
The Fed still matters, certainly. You know, I often tell investors that something about the December really gives us the excitement of, are they going to cut? How much are they going to cut? What is it going to mean? The reality is focus on the fact that they can. We have that stimulus in the environment to suppress volatility when it rears its ugly head, number one. Number two, we know where we're going. We're going to a lower rate, to a neutral rate that is below where we are now. And one might even say, actually, the neutral rate is likely to move lower, just given the fact that we've got increasing amounts of dovishness opined on the Fed. We've got in May 2026 a new Fed governor, new Fed chairman that will lead those conversations and likely mean the new neutral is an easing-oriented policy.
Do you think that the economy and specifically inflation will cooperate with that? Clearly, the desire for lower rates is there when you take a look at the Trump administration and likely the next chairman of the Federal Reserve. But in terms of actually lowering rates and resetting that neutral rate lower, how do price pressures come into the picture?
Very good question. I think that's the elephant in the room of what's going to happen with price pressures. Two things on that. Number one, it's interesting that we've recently seen this conversation move towards affordability from inflation. And with the president now doing a roadshow around the nation talking about bettering affordability measures rather than talking about inflation metrics, that's going to be a push on one area. The second thing is, of course, it's a dual mandate Fed. It's labor and inflation or stable prices and full employment. We've increasingly pushed on full employment as the target metric with inflation, even though core PCE is at 2.9%. We seem to say that's okay as long as it's not moving. Let's make sure employment is safe. Employment is a growth-oriented target. So a push on that over inflation will lead to better easing.
Yeah, absolutely. That focus on the labor market, definitely don't want to forget that. Let's talk a little bit about valuations, because Romain asked the question, how much does the Fed matter? How much do valuations matter, especially when you take a look at the hottest areas of the market? That has been big tech, that has been AI. How does that evolve in 2026?
We believe that we can remain stable at valuation as long as we continue to see the capital expenditure train continue. Now, we may see a diversification between those that are the haves and have-nots, or the large cap and the mid and small cap, i.e., do we see that broadening in the environment? When we look at the average forward PE multiples, it's about 10 points higher on the top 10 stocks right now than we see on the other 490 stocks in the S&P 500. Both are still relatively high to history, but we could see that continue. We could see, as we see capital expenditure increase, as we see potential productivity gains, as we see a release of consumer stimulus, we could see that multiple remain the same while we see earnings go up.
There have been several strategists, as they sort of plot out 2026, Adrian, that have talked about this idea of allocating a little bit more money outside the U.S. Are you in that camp?
I am in that camp, more in emerging markets than international markets. I think the S&P 500, the United States market, still provide leadership as we stand. And it'll be an interesting week, both this week and next week, with the number of central banks, not just the United States, that are probably going to be a little bit more in the tightening mode, if you will. And Japan is going to lead the way on that, certainly. So with the possibility of that happening, that could mean the U.S. could continue to lead the way, as it has for the last decade, on equity markets. Emerging markets are an interesting area where if we see this growth broaden, if we see the need for commodities and copper increase, then emerging markets are often the number one beneficiary of that. The US dollar then, of course, plays into the game on that of if we see a difference between international rates and US rates, it's likely to push the US dollar down further, which puts the emerging markets in a better spot as well in order to facilitate growth. So we like emerging markets better than we like non-U.S. international, but we still think the U.S. is in leadership mode.
Let's talk about the dollar a little bit more directly, because, you think about the year that the dollar has had, certainly one of the biggest losers in terms of an asset perspective. But it seems like the slide was really halted midsummer, thereabouts. And the dollar, as measured by the Bloomberg Dollar Spot Index, that is, has pretty much been stable since then. So, you think about 2026 for the greenback. Would you expect more of the same, this sort of stability that we've seen emerge, or would you expect maybe that weakness to resume?
I think we'll see the weakness resume. Now, the first half of the year with the U.S. dollar, the narrative was a little bit different around whether or not the U.S. dollar was potentially losing its status as a safe haven currency. I don't buy into that. That is a much longer paradigm. We're now much more looking at what would be interest rate parity, of the possibility that the U.S., to say the neutral rate, is more of an easing rate for the foreseeable future, whereas our international partners potentially are in tightening mode. That difference in interest rates will drive potentially the U.S. dollar lower from where we are.
All right, so returning to rate differentials. Adrian, great to get some time with you. That is Adrian Helfert. He is CIO of Multi-Asset Strategies over at Westwood Management. Now, coming up, we're getting more details on who will lead Warren Buffett's Berkshire Hathaway after he retires. The new era begins actually in just a few weeks. That conversation up next. This is The Close. Well, we're learning more about what leadership at Berkshire Hathaway will look like in the post-Warren Buffett era. The company announcing a handful of leadership changes, including the retirement of CFO Mark Hamburg. He's ending a 40-year run at Berkshire. Let's break down the people moves with Alex Rajbhandari. He covers all things Buffett and Berkshire for Bloomberg News. I want to start with Todd Combs. He's one of just 2 investment managers at Berkshire, and we learned today that he's actually departing for JP Morgan, which is pretty stunning.
Yes, it's a big news for Berkshire Hathaway. As you said, he was one of the 2 stock pickers, along with Warren Buffett, to handle that mammoth 280 billion stock portfolio. So his departure is a big sign. And, you know, Berkshire watchers and Buffett fans are really looking closely at what the investments are made quarter over quarter. So his departure is definitely something that investors are looking at today.
Well, I mean, given sort of his new role at JP Morgan, it raises a lot of questions as to exactly what Combs contributed to at Berkshire with regards to some of the investment decisions and those investment returns. Do we have any insight into specifically what he had his hand in?
Well, actually, no. The thing is, the portfolio has been divided up between Buffett, Wechsler, and Combs. But the general assumption among watchers is that Wechsler and Combs were in charge of 10% of the whole portfolio together, but we don't know which bet they've made one after each quarter. We don't know anything about their own decisions and whether, when there was a big bet, for instance, we could assume that Buffett was in charge because he was in charge of the bigger share of the portfolio. But when it comes for the smaller bets, it was really unclear. So we don't really know his track record, but obviously, since JP Morgan's picked him up for this big role to invest a lot in the in the U.S. economy.
And basically shoulder to shoulder with Jamie Dimon, more or less, in terms of the structure. So I assume that's a vote of confidence.
Yeah, there you go. But
I think Dimon knows a little bit more than we do, right?
Yeah, probably. I don't know. You know, don't sell yourself short, Romaine. But it does.
He did build that nice building.
Yeah, have been inside it.
Not physically himself.
No, I don't think he knows much about building. But who knows? I do want to talk about who's left to pick stocks at Berkshire Hathaway, because you think about the track record of Greg Abel, for example, the CEO succeeding Warren Buffett. He's not much of a stock picker. That's not in his toolkit. So with Warren Buffett stepping back, you know, with Todd Combs leaving, it feels like in terms of true stock pickers that their bench is a little shallow right now.
So indeed, eventually the stock picking, the management of the portfolio is going to fall under Abel and Wechsler, just 2 people. And Abel, as you say, comes from the operations of Berkshire Hathaway, in particular the energy ones, and is not a stock picking person per se. However, talking with analysts and observers, you know, he seems to tick a lot of boxes. He's acquired a lot of companies for the energy business. He knows the businesses inside out. He's been good with capital deployment over the years. So those are strengths that are transferable to you know, the stock picking side of things. But it's true that there's a question mark as to how they're going to divvy up the portfolio going forward.
All right, Alex, great stuff. Alex Rajbhandari, a closer look here at the reshuffling of management at the top of Berkshire Hathaway as they prepare, of course, for the departure of Warren Buffett and Greg Abel taking the reins in full, and, of course, Todd Combs going over to JP Morgan. A lot of intrigue here around a couple of big moves here at the executive front. When we come back, we're going to talk about retail. We're going to talk about the holiday season and unpack some of the data coming out early so far from this holiday season. A conversation up ahead with Anjee Solanki, National Director of Retail Services at Colliers. Stick with us. This is The Close on Bloomberg. Holiday retail spending on track for at least 3% gains this year, driven primarily by online shopping, according to new data out of Colliers. The commercial real estate giant finding in its 2025 Global Retail Trends and Forecast report that this doesn't mean brick and mortar is falling behind, with many top-tier malls seeing an uptick in Black Friday visits. Joining us right now is Anjee Solanki, National Director of Retail Services over at Colliers. And I actually want to start, Anjee, with the brick and mortar. I mean, just by coincidence, I happened to be in a mall today in the New York area early in the morning, and there were quite a few people there for a Monday morning. I don't know if they have jobs or not, but it was kind of interesting to see that there really is an appetite to physically be in stores. And I'm wondering, is this just an anomaly tied to maybe higher end malls or maybe to the holiday season, or is this more of a broader trend that maybe we've been ignoring?
Oh, 100%. So what we're really seeing right now, when we looked at our foot traffic and mobile data this year, it was fascinating to see during Black Friday that numbers have increased, anywhere from 7 to 11% of increase in footfall at certain malls, of course. So we took the top tier, American Dream, Tyson's Corner, King of Prussia. So why? You might ask. Well, it's the diversity in terms of the mix of tenants.
Yeah.
It's not just retail, it's entertainment, it's food. Netflix House opened at King of Prussia.
Yeah. It's kind of interesting though, but the malls you mentioned, generally I think of as being a little bit more upscale. Obviously, particularly with King of Prussia, you're just talking about a whole experience in and of itself. So when you talk about American Dream, which is a lot of entertainment, King of Prussia, a lot of entertainment, Mall of America, which is a lot of entertainment, and Tyson's Corner in Virginia, which is definitely more high-end luxury. I am curious as to the malls that don't fall into that category. Are they also doing as well?
They are. So I mean, when we look at it, you have to look at it in a couple of ways.
Yeah.
So people are actually going into, whether it's a mall or an open air center, to have that experience with their family. So what we saw post, Thanksgiving is, let's go out, let's go explore, let's go and, be entertained, for example. So you're seeing that even with different concepts, whether it's like, an escape concept where you're going in with your family or your friends, right? So it's about those experiences.
Oh, an escape, as in like an escape away.
Escape
I thought you
room,
meant,
yes.
Oh, escape room.
Yes,
Oh.
yes,
Oh,
yes.
interesting.
Oh, isn't that just IKEA?
Yeah, it seems like a maze that you can never get out of. But
Thanks for
there's
laughing at my
meatballs.
joke, by the way.
Meatballs
Katie
at
never
the
laughs
end.
at my jokes.
I laugh all the time. Let's talk a little bit, though, about what we're seeing in terms of promotions, because I hear what you're saying. You want to have an experience. You're seeing that behavior certainly driving where people are going. But when it comes to the state of the consumer right now, we're expecting sales growth when it comes to the holiday season. But you are seeing this narrative, especially when you take a look at corporate earnings, that folks are looking for bargains right now. They are certainly value conscious. So how does that filter into the landscape that you're taking a look at?
Yeah, I mean, definitely what we're seeing is this kind of K-shape, imbalance, if you want to call it. But value, discounts, those are all very important things. As I've been shopping, through the different stores, just to get the experience and talk to people, what I've noticed is that we actually have what they call a limited time offer. So they're creating almost like this FOMO experience for consumers, like this is limited time, get the discount because it may not be here tomorrow. So are we going to then see people spend more? Possibly, that's one route. But I also believe that what we're going to see as it relates to retail is that the consumer's definitely going to be very, budget, conscious. And in addition to that, we're going to see more and more discounts or more spend shifted to what we really need in terms of staple items.
Yeah, it's a really interesting psychology question. How do you manufacture that FOMO? But I wonder, especially when it comes to discounting and some of the more premium experiences at the more premium malls, how are you seeing brands sort of weighing that question of how do we keep that cachet, so to speak, but also be conscious of the fact that, if we don't lower prices, we might see our customer walk to the store next door?
Yeah, I mean, loyalty programs are really critical. So there's two things, right? One is when you go in and you do your point of purchase, what you're then seeing basically is you'll receive an email very shortly in the next 10 to 15 minutes with another offer. And then it will continue as a campaign to really get you to either buy online or shop within store. But I have to say what I found really interesting this season is going into the store and what I call getting the whisper discount. So as I touch and feel, I'm like, oh, this is so exciting. It's such a great sweater. I want to buy this. Well, all of a sudden, how about another 10%? How about a 10% discount or 20% discount? So it's making me purchase online, in store immediately.
Interesting. Maybe they think if you're, actually there touching it, then maybe they can nudge you over the edge by dangling that additional 10%. Anjee, great to spend some time with you. That is Anjee Solanki. She is National Director of Retail Services over at Colliers.
All right, some breaking news here. This involving NVIDIA. The shares higher in the after-hours trade after learning that the Trump administration has agreed to allow NVIDIA to sell its H200 chips to China, basically to export the slightly lower chips below that Blackwell level to China. We should point out that they explicitly are saying that the Blackwell chips are not part of this deal and that the Commerce Department, led by Howard Lutnick, is still finalizing the overall details. But the main headline crossing the terminal is that those H200 chips will be allowed to be exported to China. We're going to get you some more details on that. Stick with us. This is The Close on Bloomberg. You know, we were just talking about the increase in foot traffic in malls. A little bit earlier, I had a chance to catch up with the CEO of Macy's, Toney Spring, to talk about the increase in foot traffic specifically in department stores and obviously specifically in the big brands that he manages, including Macy's and Bloomingdale's, and his big turnaround strategy to lessen the overall footprint of some of those stores, a leaner organization. Take a listen to what he had to say.
It's not about improving the customer experience. So we've had record customer service scores. That's our net promoter score. Would people recommend Macy's to a friend? And we're seeing scores we've never thought possible at the brand. And that was a real focus of mine. We've improved the quality of the assortments. I thought there was way too much redundancy, way too many of the same things. And I thought the breadth of what we offer as a department store needed to improve. We need to go good, better, best, contemporary to classic, in a range of brands, things as we've talked about that are convenient, that you've heard of, that you count on, Staples, Levi's, Nike. And then at the same time, we've got to be there introducing new things that you haven't heard of, that are becoming more popular, because people are looking for that combination in a destination. We also wanted to make sure that our team was working together. So I'm a big believer that you need strategy, you need culture, you need leadership, and you need execution. We're now at the point where those four elements are coming together, and we're delivering a better experience for the consumer. But you can't kind of have one without the other. You know, a great culture without a great business without a great culture. The combination of elements is what I sought out to do when I kind of came into the role. And I do think that, you know, patience and determination go together. You have to have the patience to kind of lay out what you want to accomplish. You have to accept the fact that some things just don't happen because you snap your fingers. And then you have to have the determination, the ambition to kind of go after what you think is the right thing to do for the business.
A big part of your strategy, this bold new chapter, is also to shrink the footprint of Macy's. At its peak, you guys had, what, 700 to 800 stores? You're less than, what, 400 now, around 400
around
or so
400
now.
Today.
And the plan is to go down to roughly about 350. You've done a big remodel of some of the existing stores already, 125. How much further does that go in 2026?
We'll add more stores in 26, and we'll close some more stores in 26. And I think, as you described, it is working on both sides of the equation. Closing stores is not alone a strategy. Reimagining stores without dealing with stores that are past their prime is not complete enough of a strategy. So we want to make sure that we're doing both things. And of course, it's supported by a healthier digital business, one that is both a place of transaction and a place of discovery. We want to build relationships with the consumer. That means we have to be able to provide a better experience where they live. We think of the digital business as a channel at times. And I'm like, no, the digital business is actually a geography. The people who shop digitally in New York shop in their stores in New York, and they want to see a great experience, digitally, physically, and in between.
The CEO of Macy's Inc., Toney Spring, just about 2 years in to his big turnaround for the company, a bold new chapter, as he terms it.
Speaking of bold new chapters, let's stick in the retail space because our next guest took the helm of Sleep Number back in April. CEO Linda Findley joins us now on set. Linda, it's great to see you. I want to pull a line from your most recent earnings call. That was at the beginning of November. You said that your third quarter operating results were disappointing. Quote, I am not pleased, but we're on top of the reasons and we're moving quickly to stabilize all elements of the company. With that in mind, what is top of your priority list right now?
Really, we're focused on three key things to turn this business around. One is making sure that we're refining the product set to meet customers' needs and the value points of where they are right now. Two is completely resetting our marketing infrastructure to make sure that we can really measure and drive ROI with marketing. And then three is looking at new distribution channels kind of going forward in the business. That's all built on a foundation of cost savings, and that's been a big part of what we've been doing since I joined the business.
Do you have your team in place? I noticed that last week you named a permanent CFO, Amy O'Keefe, effective Monday. So do you have the bench that you need to execute those different elements?
You know, we've really made a lot of changes with the executive team, and people are either in new roles or we have new people in seat. So some people moved around, and I think that's the right approach for where we are as a business, because the needs of the business going forward are slightly different than where they were in the past. And I do think that we have the right team going forward to execute on this turnaround.
I am curious just about the overall retail strategy for something like mattresses and sleep stuff. Obviously not the kind of product that people buy routinely.
Correct.
It's, at least for mattresses, it's for most people, it's once every few years. Maybe for pillows, a little bit shorter than that. How do you sort of increase business, or I guess I should say, how do you get more money out of your current client base? Is there a way to increase business without necessarily having to increase the number of people in your store?
Well, a big part of what we've been doing over the last several years is creating value in the product that has really driven our average retail per unit up over several years. But a big part of what we're doing going forward is looking at how do we expand into new TAM to drive new customers into the business. So sheets, pillows, a lot of those things should be replaced pretty regularly, and so that is definitely a part of it. But we see a lot of our loyal customers actually upgrading their beds to some of our newer beds that provide heating, cooling, other sort of technologies that allow you to actually get 52 minutes more sleep per night. Because of the technologies we put into place, and they might move their older bed into, their kids' room or something like that. And so that's where we see a lot of our sort of opportunity with our customers.
Okay, you intrigued me at 52 minutes. Not that I have an extra 52 minutes to spare, but that's very precise.
It's not an extra 52 minutes of sleep that you have to extend. It's actually just making 52 minutes of your sleep better.
I got you. On that point, though, I bring that up and kind of in jest, but also just this idea. Obviously, every company, every consumer product company, you have to find ways to innovate. Take whatever the old product is and find a way to sort of make it fresh. How much effort and, more importantly, how much money goes into that type of research and development of new products or of a way to refresh old products?
We've historically had a fairly strong research and development group, and we've actually recently pared back a bit to take advantage of some of the research and development we've already done to create new products and really make those connections with clinical data that matters for our customers, and at the same time focus our energies on more near-term improvements into the product that customers want now. And that's a big part of what we're excited about in 2026.
And I am curious, you mentioned a little bit when it comes to the marketing strategy, how much of your budget is devoted to marketing as you think about bringing in that new customer and actually expanding that TAM?
So we focus a lot on thinking about the different types of marketing we can put into place. So we focus around anywhere from 11 to 13, 14% of our revenue on media to bring in new customers and also engage our existing customers. And that's really important from a return standpoint because we need to keep explaining the benefits to customers going forward. But a big part of our strategy right now is making every marketing dollar more efficient. So we've actually pulled back on marketing dollars in comparison to the past, and each one of those dollars is getting us more in return going forward. We're planning that into 2026 as well.
And you think about the landscape and some of your rivals. I know that Mattress Firm and Tempur Sealy, for example, actually joined forces earlier this year. They now operate as Somni Group International. Have you considered any of those strategies, perhaps combining with a peer or potentially selling yourself?
For our focus right now, it's really about right-sizing the business and getting it on the right track going forward. We have 60% gross margins in our business. We are a negative working capital business, so we have a really big advantage when we start to bend the curve on the growth. So we're focused right now on our strategy for 2026 and actually driving growth within this business.
I'm curious with regards to your business model. Obviously, most of your sales are originating from the actual physical retail store itself.
Correct.
I assume because people want to obviously test out what they're going to be spending, a third of their life on. But it gets to this idea as well as to how you can increase online sales if that is a priority at all.
So our online presence actually both feeds online sales as well as our store leads. And so the store experience is incredible. Our salespeople are incredible. They really walk you through how you actually use the bed to help improve your sleep, how to make sure you're finding the solution that's most comfortable for you. We also have the advantage, though, of we are the only fully adjustable bed out there. We adjust firmness by side, we adjust temperature, we adjust a lot of different parts of the bed. So in some ways, it's also the ideal purchase online because you can adjust it to your needs every night. And so it's less important that you actually worry about how it feels in one moment in the store. It's more about how you can actually adapt it to your everyday life.
Where does growth come from long term?
I think growth long term comes from expanding our TAM into the highest growth segments now, which really focus on the millennial markets. That's the fastest growing part of the business, and that's the fastest growing audience. And how do we create that premium experience that brings value to consumers during a time where they're feeling pressured about every dollar they spend, yet, as you mentioned, this is where they spend a third of their life, so it's an extremely important purchase.
I'm just curious, though, but on the adjustable side, I mean, I've seen other brands with adjustable beds. You're saying they're not the same fully adjustable.
So there's a difference. The core DNA of Sleep Number is really about the adjustable firmness, which is fairly rare, and you combine that with the adjustability of head and foot, and then you combine that with more than 900 patents across different temperature technologies, et cetera. It's rare to find all of this in one package, and that's what we do.
And final question, what is your sleep number?
Oh, my sleep number is 35.
All right.
All right, Linda, really appreciate it. Thanks for being here. Linda Findley is the CEO over at Sleep Number. Katie?
Meanwhile, I do want to go back to some of those headlines that we got earlier today, earlier in the show. Let's start with PepsiCo. I thought that was really interesting. You're not seeing too much of a reaction after hours, but the big headline there that PepsiCo is planning layoffs. We know that it has been engaged with activist investor Elliott Investment Management. We're starting to see some of the news trickle out from what those discussions have looked like. The big headlines, again, seems to be that they're planning layoffs, but Elliott also pushed for changes when it comes to their brands, their declining share of the beverage business. And so it's going to be interesting to see what else we get out of this as they wrap up those discussions.
Yeah, the company also putting out a few targets here, saying organic growth for the preliminary, I should say, for the second half of 2026, their fiscal 2026 year that we're in right now, should be in the range of 2 to 4% on the high end of that range here. So giving some guidance as well, seemingly trying to push back against some of the arguments that Elliott has been making with regards to what it sees as mismanagement.
Yeah, absolutely. And we should say that this is according to people familiar with the matter. You remember that Elliott announced this $4 billion stake with PepsiCo in PepsiCo back in September. So it hasn't been that long, about 3 months' time. Apparently, Elliott is supportive of the changes that are being planned by PepsiCo, so not a hostile situation here.
Yeah, the share's not doing too much in the after-hours trade. Meanwhile, Katie, we should just revisit real quickly NVIDIA. Those shares now moving even higher, up more than 2% in the after-hours trade on the back of that news that the Trump administration will allow NVIDIA to sell its H200 chips to China. Of course, these are not the really high-end Blackwell ones that I think they would prefer to sell, but it certainly is a start. We should also point out that the deal that the Trump administration is working on has not been finalized, but it explicitly does not include those Blackwell chips.
And it's also interesting that, the president also saying that the U.S. will get a 25% cut of the sales, that basically NVIDIA has been granted permission to ship that H200, as you say, not exactly the top end model there, to China in exchange for a 25% cut of the sales. A really interesting move in terms of the capitalist implications there. Certainly unusual to see.
Unusual to see, and I can assure you there will be a lot of lawyers questioning whether this is actually legal, and a lot of lawyers who will make a lot of money off of it. I should point out that the president also saying in that same post here that the same approach, in his words, will apply to AMD and Intel. So this does appear to be more of a broader strategy by the Trump administration.
I think it's interesting that, when we're talking about this revenue share, if you want to call it that, President Donald Trump did say in his post that we will protect national security, create American jobs, and keep America's lead in AI. The national security bit, we know that has a broad definition by the Trump administration, but in terms of the 25% cut, I don't know how exactly that fits in, but I imagine that we're going to be talking about it.
All right, we will be talking about it. Of course, the president out with the social media post saying he's already spoken with Xi Jinping about this, and Howard Lutnick is on the case and working on it. We'll stay on the case as well and bring you any more details as soon as we get them. This is Bloomberg. All right, let's push ahead to what the markets will have their eyes on over the next 24 hours. And believe it or not, Katie Greifeld, it includes more earnings.
Yes, from Campbell's. We get
the
that
soup company
before the market. I'm excited for the after hours.
Down an executive.
Yeah, there you go. We'll talk about that. We'll also talk about GameStop, Dave & Buster's, and Cracker Barrel reporting after the bell.
Cracker Barrel.
Cracker Barrel. Remember?
They're still around.
Yeah, they sure are.
I thought they were canceled.
Well, they have their old logo. They, did a little bit of a 180 there. It's interesting. You take a look at the shares, never quite recovered from that snafu in mid-August.
Yeah, a real snafu there. All right, we're also going to get some economic data. The NFIB small business optimism coming out at the very bright and bushy time of 6 a.m. and then at 10 a.m., Katie Greifeld, an update on the labor market.
Yeah, a little bit more of a pedestrian hour. And then all day, we're going to have CVS having their Investor Day. CVS, one of the shining stars of the stock market this year. Also, Home Depot hosting their Investor Day as well. So we'll be on headline watch from both of those companies as well, Romaine.
Yeah, absolutely. And it's interesting, too. We talk about strategy going forward. CVS has actually had a pretty good year.
Oh, big time.
Of course, the comparison to the last couple of years maybe helps that out. Stick around. All your politics coverage coming up at the top of the hour right here on Bloomberg.